Welcome to the last lecture of this section, which covers cash flow projections. Now, what is cash flow projections? So I want you to think of these projections as something that we are projecting into the future or forecasting into the future. So just think about a weather forecast, for example. You're trying to predict the future, you're trying to guess what's going to happen. That's very different than what a profit and loss statement is. A profit and loss statement is pulling data from something that actually did happen and looking at that data after the fact. So I ran my business through the month of January, and then I made a profit and loss statement, and I looked at the revenue and all my expenses for the month of January after January ended, right? That's a profit and loss or income statement. So for this financial forecast, I have a template that I'm going to give you to use, and it's a 12-month cash flow forecast. So you can do a prediction of what you think your finances for your business are going to look like for the next year ahead. There are also 2, 3, 5-year cash flow forecasts that businesses make that can also be helpful tools. For right now, and for the sake of teaching you how to use this tool, we're going to look at the 12-month one. So why is this so important? Because most businesses have seasonality. And here's a little seasonality graph to show you as an example. Your sales are not going to be consistent day to day and week to week and month to month. They're going to change over the year. And all businesses have seasonality. So for example, I go to yoga in my town, and I notice that in the wintertime, the yoga classes are packed and everybody's in the studio. And then in the summertime, when the weather's nice, there's maybe only 2 or 3 people in there. So if you're a yoga studio, you have to anticipate that your sales are going to be very high during the winter months, and then you may have a very low attendance rate during those warmer weather months or during those summer months. And you have to account for that as a business owner. Will you either put aside reserves and put aside revenue during your high sales months so that that can help you float and that can help you get by without having to lay off staff during your lower attendance months? Or maybe you run different sorts of sales during the year, especially when you anticipate that a slow season is coming, to bring in more customers. So I want you to ask yourself, because this is going to be unique to your own business industry, when does your product or service sell best? And when are sales lower? When do you need inventory? When do you need to purchase inventory and stock things? When do you need cash on hand? And when do you need the most help, meaning the most labor, the staffing? Is it a specific time of year, a specific day of the week, or time of the day that's going to be important to you to have staffing? This is the template, which you will get to play around with. And please download this, save a copy, and then you can just use it, change the expense categories, the revenue categories if you'd like to. Everything else does have built-in formulas, and I'm going to go through how it works. So on the top here, you'll see all the way on the top left, it says beginning balance. So that's the beginning balance in your bank account, in your business bank account at the beginning of the year. So you can write an estimate here, because again, this is just our forecast. This is our guess. Maybe you do know what your account has in there right now, but what's your guess of what it's going to have in it come January 1st of the year we're starting this? And then you can list here, and you can make more lines if you need to, all of your different revenue streams, because we want to see it broken down by particular revenue streams. We don't want to just see the total. And then start filling it in month to month. So how much in sales for each revenue stream do you predict in January, in February, in March? When does your seasonality kick in? When might sales be higher? When might sales be lower? And what it's going to do for you here, which is nice, you'll see between each month, there's a little percentage sign. It's going to calculate a percentage for you, so you can see what percentage of your total revenue is coming from which revenue stream. So that goes back to the 80-20 rule. You might be able to see what's your 80% of sales. And then it's going to give you yearly totals all the way at the end. Now, here are the expenses below that, and feel free to change any of these expense categories. I just put very general ones in here that typically match what's on a Schedule C with the IRS reporting for taxes. but change them if you need to and make those same estimations. Now, if you've already been in business, you might be able to look at past bills, and those past bills might be useful to have your best guess, your best intelligent guess of these different expenses. So fill them in, and you'll notice that the percentage formula is here too. That percentage formula will also let you know what percentage of your total monthly expenses are coming from what expenses. So you might realize, oh my gosh, most of my expenses are staffing, or most of my expenses are my mortgage, etc. So it's going to give you some information as a business owner. And then at the very bottom here, where it says monthly net, it is going to calculate for you whether you made a profit or loss in each of those particular months. And then it's going to give you a total right at the end, showing you if you made a profit or loss. And the ending balance, it's going to calculate, because remember at the beginning on the top left, we put in the beginning balance of our bank account. It's going to tell you from each month how much money you predict you're going to have left in your bank account and what your ending balance is going to be at the end of the year. So let's take a look at an actual example that I have filled out. Okay, so here is the sample 12-month cash flow projection that I have filled out for you. So you can see there's a lot of numbers and data in this. Sorry if this is a little small on your screen. I'll make it bigger as we go through it. But what I want to show you is at the bottom, what I did, and I mentioned this before, I made different tabs, and I have on the first tab a high revenue forecast, and then I have a mid-revenue forecast for the same business and a low revenue forecast. So if we look at the high, you can see up at the top, it says high revenue forecast is the assumption that I am 95% full with customers. And in this example, I did a childcare center and I put the number of slots. So my high forecast is my school is 95% full. My mid-revenue forecast assumes that my program is 75% full, and my low revenue forecast assumes that my childcare center is only 50% full. So I can look at what happens and what decisions I might need to make as a business owner if I can't fill all of those spaces. So this is super, super valuable. And again, it's something that a lender or an investor is going to want to see. And they're going to think you're a very smart business owner if you've done this with these different tabs, because they're going to be like, wow, you know, he or she didn't only just plan for everything being great in sales, they really plan for the worst case scenario, and they can prove to me that their business can ride out the worst case scenario. So that is super valuable. Looking at the high forecast first, I'll make this a little bit bigger now. You can see I've got my revenue streams listed here, and then I've got the month to month here. And highlighted here in red is where my seasonality happens. I start to have a little bit of a dip of enrollment during the summer, because even though I'm running a summer school program, a lot of families are on vacation. So let's see how that dip affects, oh, you can see I went into the red, my profit or loss. So whereas in the other months, I've got a little bit of a net going, I've got a profit going, during the summer, I'm starting to operate here at a loss. And then it picks up again as the school year goes on, as September starts and children come back to school. And you can see even with the bank account, I put in 0 as the beginning balance. I didn't put in a number. Let's say I started with $10,000 just to change that. And you can see how all of those numbers just changed. You can see it's also showing me the percentages. So looking at these percentages, the majority of my revenue is coming from private pay tuition, and it's coming from DHS subsidy payments from the government subsidized childcare spots. And then down here, I've got all of my expenses, and it's also showing, you can see it's showing 100, that it's at 100% expenses. When you add all of these up, it's showing all the different ones. And teacher wages is almost 60% of my average expenses. Looking at my mid-revenue forecast, look at this. If I'm 75% full, I'm actually in the red, and I'll make this bigger again, consistently. The entire time I'm operating at a loss. So that tells me as a business owner, I've either got to cut costs, I've got to charge more in tuition, or I have to somehow manage to be more than 75% full, or I'm going to be operating in the red. I need to subsidize this somehow. And then this is interesting. Just because you're in a low forecast doesn't mean you're necessarily doing worse as a business owner and making less profit, because look at this in this example. I'm in the red some months with this low 50% full forecast, but other months I'm in the black. I'm just getting by. And the reason that this happened is when I did this assumption of being 50% full, I cut the number of classrooms I had operating and I had to lay off staff. And by laying off staff, since staff wages were 60% of my total expenses, I was able to cut a bunch of expenses. So this tells me I actually can operate better at 50% full enrollment than I can at 75% full enrollment, because I still have to pay all those teachers to be there to staff the classroom. Whereas if I'm 50% full, I can start closing classrooms. So you can start seeing in this example how you can use it to start making very strategic decisions as a business owner. And the other tabs I have here, I have a tab on teacher wages where I calculated, okay, what are the licensing ratios? How many teachers did I need for each classroom for each hour of the day? What are the hourly wages in my area? And I did this off of real information to date. I put information up here about where I got this information, how much Head Start was paying teachers, et cetera. And then I also estimated all of my breakdown of all my office supplies separately. So thank you so much. I hope this has been very useful for you. I hope this is a useful tool, and I will see you in the next section.